Okay, I'll assist you now. 2 minutes.
Thank you very much.
Are you able to project?
Yeah, thank you very much, Seko. Thank you very much. I think I'm to share my presentation. Can I confirm, students, can you see my presentation? Very much. Thank you. Thank you. Thank you, thank you very much. Thank you very much. Fanel, thank you very much. Yeah, in the interest of time, let us be ready to proceed our own session for today. Let us be ready to proceed so that we can be able to deliver on the goals and objectives of the session for today. I'm trying to balance up my presentation. If I've put in a presentation mode, I might be able to see your comments. So I think let me just enlarge it so that I'll be able to participate concurrently, looking at your input and the presentation concurrently. Basically, for today, we'll be able to dispose around the inventory, issues around the inventory systems, issues around the inventory valuation methods, engaging around on the depreciation in terms of the look at the assets and how are you expecting to make sure those assets are losing value in terms of the accounting policy. We are also going to engage on the issues of generalization, in terms of purchasing of inventory and how you expect to generalize them. We'll be able to talk about, bank reconciliations, why the bank reconciliation is important, why is it necessary, and what are the grounds. Basically, those were the issues that we were able to be engaged in the session in terms of your study unit. I articulated in terms of the overview of the concept. In terms of this concept, everyone is aware the business to exist to make profit, and in order for the business to make profit, it must be able to sell. And what is being sold is a stock. We call it a stock, it's a trading stock. So our purpose for today is to make sure that we understand the accounting dynamics around those key concepts. We articulated in terms of the presentation, but what is a trading stock? Why is it important in the business? In a simple discussion, for the business to exist, it must sell product to customers, and customers should be able to pay. That trading stock, to a certain extent, you must have some contractual relationship in terms of your wholesaler and supermarkets. That is where the duty mainly for the attorney, for the people from the legal field, comes in terms of advising the contractual relationship between the two contracting parties. we know we're talking about the drawing up of contract. To say as much that, we're in business, but if you are closer to the customers, we are selling the individual products, but the wholesaler is selling on bulk. So what a contractual relationship can we enter just to make sure that I be able to deliver on the mandate in terms of your sales. So we're drawing up some drawings in that regard to assist the process. As part of the process, certain contracts can be breached. Legal implications in terms of violation of that, it also needs to be unearthed. It becomes critical the role of the legal expert or the legal consultant or the attorney in that regard. There were certain issues as well in terms of the insurances. You've got trading stock in your shop. You are also subjected to the unforeseen circumstances, which might involve fire, floods, and so on. That can damage your trading stock. So in that context, you as part of your risk management process, you engage the insurances. Part of that process, there are certain claims that need to be paid. Obviously, there are certain terms and conditions that need to be observed by both parties in terms of the insurance company and the business itself. So it's critical for us to understand in that context. When you talk about trading stock, you are actually referring to what you have in your business, But in terms of your legal, you are selling service. Those services are also important. Servicing the people in terms of the legal matters. We call that one is a service. But for business, we call it is a trading stock because they're selling the hard product, the finished product to the community and the general public in large. The academic theory makes some reference in terms of the trading stock insofar as the valuation method are concerned. There are two methods that are being used in the business sector to make sure we're able to calculate the cost of the inventory. One method that is being advocated in the academic cycle is a periodic inventory system. In simple terms, what it says is a periodic inventory system. For you to know the cost of the inventory in business, you decided to say it's an every 6 months or in annual basis, I will shut it down my business and allow my team, employees to calculate what do I have at hand. So that process, we call it is a periodic inventory system. The cost of the product, you don't know during the year up until the last date of the financial year. And at that particular time, we conduct what they call it is a stock taking. A stock taking is part and parcel of the periodic inventory system in the business. Therefore, in that context, the cost of the product or the cost of sale, at the end of the financial year. So that we call that method as a periodic inventory system. Then the second one, we call it is a perpetual inventory system. You can go to retail industry in many instances. They are using this method. If you go to the till and you buy a particular product, but the machine will be able to determine the cost per each product that has been purchased. We'll be able to do that. If you go to the till, you can see the cashier will be able to scan all your product. And that system, we call it perpetual inventory system. Why is it perpetual? It's happen as you sell your product. It's happen as you sell the product. Doesn't wait a period to lapse. So it's what is happening here in terms of that particular system. We agreed on this system. When you do periodic inventory system, it happened that the inventory that is at the store, after your discussion, after your calculation, you'll be able to identify that you've got a surplus. You can be able to identify that you have loss. Why you can have loss? Obviously, inventory is subject to theft. Is subjected to theft, meaning that when you make some reconciliation to check what is on the ground versus what has been recorded in the books, you can see it does not up. It can happen that there is a theft or there's a damage of your inventory, which pushes the organization now to do value your inventory so that you can reflect what is actually reflected in terms of the existence. You can actually have as well, a surplus. A surplus, it arises to, in so many instances, maybe you fail to record your inventory in an accurate manner during your purchases process. Then when you reconcile what is on the ground is actually higher than what has been recorded in the books. In that context, you experience what they call as a surplus. The accounting treatment for those are also different. A surplus is treated as an income. Then the deficit will be treated as an expense, as a loss to the organization. So those are accounting dynamics that are involved, in that context. On this slide, we are just indicating, to say there are so many methods of purchasing. You can purchase on cash, you can purchase on credit. In the case that you are selling your products on credit, when you're selling on credit, it means that the payment will be made in a later period, a 30 days period. So all those, purchases, when you talk about merchandise, you're actually referring to the trading stock. A merchandise is what you are selling, regardless of whether it's a bread or it's a cement, but the context of your business, we call it as a merchandise, trading stock. So these trading stock are being recorded to a particular books, and what we call these books, we call it a purchases journal. If you buy these products for purposes of reselling customers, you create up your own books.
Mr. Nelani?
Sorry to interject and to disturb you there, but unfortunately we cannot see your screen.
My screen is not reflected.
No.
It's reflected, but the slides are not showing. It's showing the first page, the cover page, I think. But going forward, everything that you've been talking about does not show.
It's not moving.
Nothing.
No.
Okay. Let me just leave the class and rejoin. Let me just.
Okay, so.
But I will share to the group while I'm still engaging so that we can be able to access it. Can you see my now?
Yes, it's on page 4 or
Yeah.
slide 4.
Let me just quickly go back because I was not aware that you can't see my. Let me just give you some mention. That was my page 1 for this. I was just articulating the issue relating to just the overview of the concept in terms of the inventory. And we articulated that to say inventory is what keeps the business into an existence. It must have stock. That stock must be sold out to the public, to the customers. So we articulated that one. We also bring in terms of the legal elements, your skills can be valuable in this process, in terms of, advising on contractual relationship between the entities. Let us put for an argument to say, we've got a wholesaler that's selling for spaza shops, and the spaza shops will be able to sell for the general public. At some stage, there are no cash at hand, to purchase the trading stock for the purposes of reselling it. We end up with certain agreements to say, I'll be able to pay over, my liability or my financial obligation in a space of 30 days. So your legal aspect, consultant becomes key in that aspect. Obviously, once you have a contract is subject to breach for either unintended so due to unforeseen circumstances. The legal expertise becomes also key in ensuring that appropriate remedies are being advanced in terms of ensuring that the terms and conditions of the contract are complied with. We articulated the issues regarding the insurance. You can have stock, but those stock can be damaged, can be stolen, and so on. You must have the insurance as part of the risk management. In the process, the insurance sometimes decline to pay claims on the basis of certain issues. Then the legal expert can come forward and advise what is expected, what is an appropriate route if you experience such challenges in that regard. On slide 2, I think I spent a little bit of time on this one. Generally, whether in the international setup, there are only 2 inventory systems that are being used. The first system is a periodic inventory system. I explain what does it mean. Is it periodic? Everyone, I think, has got an experience when you go to a particular shop and this shop has been closed for the whole day, but you are being told that the business is not operating for today, is busy with the stock taking. So that process, we call it, they want to know what is the value of their own stock. We call it a periodic inventory system because it is done in a particular interval. So that the cost of the inventory that the businesses have at a particular period in time, we call it is a periodic inventory system. Then the second one is a perpetual. We try to simplify a perpetual to say, if you go to in a retail shop like Spar, in Acacia, you can see there are a lot of scale process that is happening per each product is subjected to that process. And that process determines the cost of the inventory that has been sold out to a customer at that particular point in time. So there is no way that you can wait a period, before you know what is the cost, but the cost is determined as the product is being sold out. We call that system as a perpetually inventory system. It's an ongoing system. It's an ongoing, hence we call it as a perpetual inventory system. We agreed on this one to say you can do your periodic. You go to verify physically what you have. You can come across with the challenges of deficit, and the deficit arises in various forms. Arises on the basis that if maybe some certain stock has been theft, can result to a deficit and the deficit is treated as an expense. At the same time, you can come across with a surplus, and the surplus is very scarce to come across with a surplus. A surplus might be arise on the basis that your original books have not been captured in terms of your inventory, in accurate capture of your inventory. Then when you physically calculate your inventory, does not tie back to your books, hence can result to your surplus. And there's an accounting treatment for that to treat as an income. That was slide 3. We articulate it in terms of the slide 4 to say when you talk about merchandise, we're actually referring to a stock. A stock is what we have, what we are selling, whether it's a bread or it's a brick. If we are hardware or we are the shop, we are referring to the clothes that are being sold. We call it a merchandise, and the merchandise can be sold on cash basis, can also be sold on credit basis. But after those particular transactions that has been occurred are being recorded in your purchases journal. A particular example, if you are selling a product, you are not a factory of that particular product, meaning that there are suppliers that you are purchasing your products, your products from. When you purchase those products, you pay those products that are being transferred to your business premises, and under your business premises, there's a well-designated area. We call it a to receive those material. After those material has been received, will be allocated in a particular area. Then the movement of those products are being recorded in your receiving notes, and the receiving notes will also be used to create purchases journal. All the issues that has been purchased on credit, we call it recorded in your purchases journal. It's an obvious matter that if you on credit, is the accredited terms that are being granted by your suppliers. When you talk about your suppliers, I'm talking about your creditors. So certain terms in terms of the payment period that are being offered for accounting purposes, you created up this purchases journal. You created up what these purchases account. You debit your purchases account in terms of your credit stock. You also credit your credit payables. Your credit payables is your creditors. Is just the terminology. But a critical dilemma on the same branch of this particular transaction, there are certain goods which can be returned back to suppliers. Yes, goods that can be returned back to suppliers. What are the contributing factors of those particular instances? Let us say, for example, you purchase the product, but it's not the brand that you are purchasing, but it has been, you've purchased the right product, but the supplier has delivered the wrong product. Under those circumstances, you are obliged to return those products. And how do you begin to identify this is the wrong product? During the delivery of these products, the receiving big clerk will be able to look at the purchase order vis-a-vis the delivery note. When you compare, yes, it's a product that we ordered, but it's not the quality that we agree. This brand is not a brand. So in that context, we have to return those goods. But in the process of returning, you don't just return in a physical manner only, but you create what we call a purchases return journal. It's a purchases return journal. So you journalize that to make sure that there's a proper recording of those transactions, to make sure that there's a proper accountability. So you must make sure this is captured to say this is a practical incident. It applied to the business, it applied to customers as well, but this is a first leg in terms of discussion. We also, experience in our own business environment, there are certain discounts that are being, offered. When you buy in purchases, for example, obviously you can enjoy some advantages in terms of the trade discounts. those trade discounts, we also need to make an appropriate accountability in terms of your books by make sure that the discount that has been or offered by or allowed by your suppliers, allowed by your creditors, allowed by your suppliers, you should be able to make an appropriate accountability in terms of the invoice. If you purchase something which is at 100 Rand, but you offer the discount of 5 Rand, obviously paying 95, but that 5 Rand, it needs to be appropriate accountability on our own books, because it's a trade discount. It's a discount that has been allowed by our own suppliers. We always make a distinction in terms of the trade discount and the discount offered or discount settlement. Probably at this stage, we can just open up a discussion just to stimulate some around what is the thinking in terms of what discount allowed and what is a settlement discount in business sense. Is there anyone want to just to provoke the thinking around these discounts in a business sense? What is your understanding or what is your thinking around the discount allowed and the settlement discount? Anyone to attempt discount allowed or discount settlement discount? What is the distinction? What's the difference between the two? Or maybe let us put a practical example. A practical example, what type of business can we use? Let us use hardware. All of us will be familiar with the in terms of hardware. We are buying a material for making bricks is inclusive of cement. Let us inclusive of cement. Now we are buying cement, 200 bags of cement. Now supplier A offered us a discount of a discount of 10%. A discount of 10%. We are buying in quantities. The bags are 200. We need 200 bags, and the cost for each is 110. We agree that we need to pay 22,000 for this, 2,000. Then the discount is 10% is being offered. A discount that is being out is 10%. So I want somebody that will come and lecture us around this matter. We've got a 10% discount that is being allowed. At this time around, we are the hardware business selling bricks. Now we are buying material so that we can be able to make these bricks and resell to the public. So we agreed that the total cost that cost the product is 22,000. Then the discount is I'm going to write the discount is at 10%. Discount is at 10%. So now I want us to make an articulation to say 10% will be a discount allowed or will be a settlement discount. Each and every scenario must have why. Think like a business is you purchasing a material for purposes of making bricks and the public as a hardware. So we are offered a discount of 10%. Is it a settlement discount or is it a discount allowed, and why? Any attempt? Nozipho Hlophe, Madladla, Pem, Halleson. Look, a discount that is being allowed in the context of business is we are the business, as much that we are the business, we have to order these things in bulk purchases, and suppliers normally offered the discount allowed. We call these ones as the discount allowed. But when you sell your products now to your customers, to your debtors, if your debtor, you allow 90 days to settle up their account, decided to settle it in a 30-day period, you offered what they call it is an early discount or settlement discount. And that one is enjoyed by the customers in terms of your
I'm sorry, sir, we can't hear you.
Apologies for that. I'm experiencing some network challenges, but I think it's restored now. Yes, we articulated that. I hope people do understand the dynamics of a settlement discount and the discount allowed. Where does it apply? Because you'll come across with this terminology and they are likely to confuse you if you don't really understand the principle that underpinned. But what I like about this, the discount, settlement discount, is what we enjoy, the majority of us. We know very well that if you are servicing your account very well, there are certain benefits that you enjoy in that context. And many business sector, they call it a segment discount that is being enjoyed in that context. Then we articulated to say, let us think that you have managed to purchase your product from the suppliers and you put in your business setup. Then you sell to the public. And whatever that you sell to the public or to the customer, that one in terms of your sales channel, you're recording those ones in terms of your sales channels. Whether you move for the approach of the credit sales, you also move in terms of your customers in this context. They call it will be your trade receivables. These ones are your debtors. Should a particular shop, granted you credits to take a particular product on credit, you are being referred as a trade receivable, as a debtor in this context. Equally applies in terms of purchases. If you buy product, but when you fit it, or maybe you buy for somebody else who is not in a province, but when you deliver the issues, this person says this size is not fit for me, it's too small or it's too big. There's a responsibility to return those products to the supplier, to the shop, and we are calling it as a sales return journal must be also taken into account that movement. So you need to be critical in terms of saying what, my accounting books in terms of customers, if a particular customer purchases a product and if a particular customer returns a product, which books I have to record those transactions. If you sell, you record your sales in terms of your debtors account. Then if you return, you record those ones in terms of your sales returns journal. So this journal is just the terminology in terms of the accounting field. But in essence, these are how we record the movement of this transaction and make sure that there's a proper accountability. Come again? Anyone want to chip in? Okay. So these are, yes.
So can you please click on this arrow on your, there's a certain arrow so that we can see properly the entire page. I don't know if it's going to be on your far right.
Yeah.
Just below share, there is an arrow that is facing up. Can you please click on it?
Yes, I've put it on my side in terms of presentation mode.
Oh, okay. So
you can't see.
Now, in terms of, because I can see that here on your there are headings. The headings, we're not seeing the headings, but we are seeing the explanation. For example, the page here is starting on merchandise, but then on top of that, they can see that there's a heading. So we cannot see the heading.
Or the heading.
Yes, the heading. So maybe if you can press the arrow on your far right, there's an arrow just below share. There's an arrow that is facing up. If you press it, then the entire page will be able to show. Yeah, now it's fine. Thank you.
You can see now.
Yeah, thank you.
Okay. Actually, I reduced the size. Yeah, this one I was indicating that is similar to the previous slide, but now it's a relationship between a customer now. It's your business with relating to the customer. But what transpired on that regard? What transpired if your customer, settled their account before the expected time frame, e.g., if you give them 90 days or 60 days to settle, but decided to settle their account in a 30-day period, you offer a settlement discount. You offer a settlement discount in that regard. I think I articulated that one very well. We are articulating on this one to say the relationship between business and the customer has its own dynamics as well. One dynamic is that they can purchase your trading stock in the form of, regardless what we are selling. But if the customer notice that when he's at home, that this product is, it's not right for me or it's not right for my kids in terms of the size, if you purchase shoes, instead of, your size 6, but my child now, it seems this size 6 is not fit. So we have to return. But under those circumstances, we have to record your returns in terms of you record on this. But during your purchases, during your selling of your products, you record under your sales journal. Whatever that is being sold out to the customers is recorded under the sales this terminology, you need to make sure that you understand there's a purchases journal. Where the purchases journal that is being applied is between you and the suppliers. Is between you and the suppliers. And whatever that is being purchased to the suppliers, if there are certain discounts that are granted there, we call it a trade discount. It's a discount allowed to you simply because maybe you purchase in bulk purchases. But if you're not happy with the stock that have been purchased for various reasons, you return those ones. So you must be careful in terms of this terminology to say the purchases journal is applied under which circumstances is between you as a business and supplier. But when you talk about the sales journal and sales return journal is between you and the customers. Your customers is your general public, whatever that one that is coming to business and purchase your product. And under which circumstances that you record the sales journal. You record under the sales journal whatever product that is being sold. But if customers return by tomorrow to say, I'm not happy with this particular product because of this, because of ABCD, you record that in terms of your sales return journal. So that is a distinction between the two. Then what we call it is a general ledger. Under the accounting profession, they call it is a GL. It's a general ledger. A general ledger will be able to be, draw up in a business in a particular month and period to record all the transactions that has been occurred. To record, obviously, the issue of debit and credit will be fundamental because the general ledger will have a side in terms of debit, will also have a side in terms of credit. So you'll be able to record all the transactions that has been occurred in that context. I explained the issue of the settlement discount. I think we are enough, but I've tried to articulate and engage the student to say, what is your understanding in terms of settlement discount? Because critical to that, you must know when the settlement discount is applied on the basis of purchases or on the basis of sales. So you must make sure that you know very well that if there's a discount allowed, what does it mean? If there's a settlement discount, what does it mean in terms of your business? We also have what we call it in business is a value-added tax. We call it a VAT. There's an ongoing articulation in our own country, whether to increase. In fact, there's already adoption in that regard to increase the VAT. Previously, the VAT was at 15%. Obviously, we can use that as our own scenario for now to say we stick at 15%. VAT is being added to the product that is being sold in a business. But for you to be able to charge VAT as a business, you must be a registered VAT vendor. You cannot charge VAT if you are not registered as a VAT vendor. If you go to shop, you can see at the bottom of the slip, at the bottom of the invoice, there is a percentage that is written there. Closer to the VAT says 15%, meaning that if you buy a product at 100 rand, which is excluding VAT, if you add VAT, it would be 115. That 15 portion is a VAT. We call it is a VAT. So it's also important to understand that one very well. But critical to that, a VAT is being paid in a certain period, in a certain intervals. But within the VAT issue is what we call it as an input VAT. Or at the same time, we've got what we call it is output VAT. Input VAT and output VAT is very critical to understand, to say who is liable to pay in, is liable also to pay output VAT in the context of a business. So it's important to understand these VAT dynamics and where it applies, and who is responsible to make a collection of VAT and pay revenue services. Any attempt for this one, what is your understanding about input VAT, or what is your understanding about VAT before we can engage in terms of the components of the output and the input? There is no wrong or right answer at the present moment. We can try. Tilidi, do you understand what is VAT?
To explain it properly, what VAT is, no, but then I think I can understand what a VAT input is and what a VAT output is. And a VAT input is like, this is VAT, the amount of VAT which is included in a product, which must be, I don't know if it is payable by the customers or what.
Yeah, don't worry, you're almost there. But I want to visualize yourself as a business owner. Think yourself as a business owner. Then when you articulate the example, you say, I charge VAT, or I paid, I charge input VAT if I do ABCD, or I paid output VAT if I do ABCD. Just visualize yourself as a business owner.
No, so I don't know, when I was studying, I realized there was something where they talk about making over R1 million, then you become a registered VAT vendor. So in that, with what you're saying, the output VAT, it is being paid, I think, by me to SARS, I don't know.
Okay. Fair attempt, anyone?
Yes, I answer.
Yes.
Hello, can I try? Am I audible?
Yes, you are.
Okay, so I'm just gonna explain it informally. If I'm a businesswoman and I'm rendering services for the state, I pay a certain percentage to SARS. I pay IRP6 and also income tax. And also when I render my services to the state, I expect the state to pay me 15% of the amount that is supposed to be my profit. I'm not sure if I'm putting it okay.
Thank you very much for the attempt. Thank you very much. Let us simplify. Let us simplify. Let us simplify. The last student is correct, is actually referring to pay as you earn. Pay as you earn is what you being taxed, as long as that you are being employed. Whether in a public or in a private sector, you are liable to pay as you earn. So pay as you earn is another type of tax that is used by the government to collect money from the workers so that can be able to render services to the public. That is how the government makes money in terms of revenue. But in terms of VAT is based on what you sell. If you have not sell anything, it means you won't be able to charge VAT. Let us make an example. Let us make an example. Let us make an example. All of us are familiar with SPAR. Ne? If you go to SPAR and purchase a product, now when you think, I'm talking about the owner of SPAR. I'm the owner of SPAR. So if I'm selling a product to you, this product is inclusive of that. No, let us simple calculations. This product is 100 Rand, is excluding VAT. If you include VAT, which is the VAT is 15%, you will have 115. Now, when you are a customer selling this product, you'll buy this product from me at 115. This 115 is inclusive of VAT. Inclusive of VAT is 15 Rand. Then in terms of the accounting, this 15% is an output VAT. It's an output VAT. I've tried to simplify this thing to my students. For now, just understand it's an output VAT. It's me, Nelan, selling product to customers. I charge 100% plus 15. This 15 is an output VAT. But if it's me, Nelani, if you go to SPAR, you can see there's no manufacturing of sugar, what there. It means I must go to suppliers to buy sugars for the purposes of reselling them. So if I pay an amount to suppliers, to Durban, for example, and Durban suppliers who are selling sugar are including a 15% of VAT, the amount that I'm paying, which is including VAT to Durban, they call it input VAT. Do you understand the logic?
Yes, sir.
It's an input VAT. For you to understand easy, you must put yourself at the center. You must put yourself at the center. Maybe you've got a shop that is dealing with this. What you buy for the purposes of reselling, it means it comes in to your business. Comes in. Then you are paying input VAT. When it leaves out your business, you charge output VAT to the customers. So it's very critical that you must understand that dynamic of output and input VAT. I fully understand the articulation that you indicated to say even employees. So pay as you earn is another type of VAT. There are so many taxations that are being used by the state, but for now we are focusing to a VAT. VAT is being charged in a products that you're being sold. Ultimately, you need to make a comparison of your output VAT vis-a-vis the input VAT. Output VAT vis-a-vis input VAT. Then that is where you see whether you are liable to claim money to SARS or you are liable to pay SARS on the basis of your comparison of your output VAT versus input VAT. So it becomes critical to understand those dynamics. At the end of the day, you do what they call this VAT reconciliation. VAT reconciliation. I think the student has also alluded around this issue to say, in the South African context, the Income Tax Act and the VAT, the VAT Act, it pushes an obligations that if your turnover, your sales, your income that you made in your business are in excess of 1 million, it becomes a must that you go to South African Revenue Service and register as a VAT vendor. It is expected that within a period of 21 days, you must do that. So it becomes law, which now in your own context now, embarking in the legal field, when you're advising your clients, you're a legal consultant of a particular firm, these are the issues that you must also explore to say, what is the turnover for the businesses we manage to register to South African Revenue Service so that you can be able to charge the VAT. So it becomes, compulsory if your turnover is in excess of 1 million in a South African context. We are articulating now in terms of periods. It does happen that other organizations were submitting the VAT returns on a monthly basis, on a quarterly basis, on a semi-annual basis to South African Revenue Service. Others, they call it a VAT 201s. VAT 201 is the articulation of your input and output VAT to make a determination how much money is due to SARS or how much money SARS have to refund us back. The issues that are critical for us to understand as a jurist. Then you also need to understand calculating VAT. What are the bases? Because we've got a various method of payment, you know. We paid after 30 days. It means that if you paid using an accrual accounting system, or you purchase on cash, at what stage that are you accounting for your VAT liability? These are the two methods that are being used. You know, we use on the invoice basis. When using the invoice basis, it means that the invoice has been issued and you recognize that particular transaction in your books, inclusive of VAT component. The VAT component has been taken into account, or on a payment basis. On a payment basis, what does it mean? It says that now we are no longer following the on credit purchasing method. You pay on cash, then the issue of VAT is also taken into account in that regard. So these are the two methods. There is no third or fourth method. These are the two methods that are being used in a South African context. The other component around the inventory, which is also critical for us to know, there is a way of, you know, inventory valuation method that is being used in a business sector. One method is called a FIFO. FIFO is a first in, first out method. It's being used as an inventory valuation method, and the last in, first out method is also used as a valuation method. The third one is a weighted average method. It's a weighted average method that is also being used. These are the only three methods that are being used in practice. The first in, first out method, what does it mean? The first in, first out method, what does it mean? The terminology is self-explanatory in that nature. If you are the business person, you purchase your inventory. You don't purchase once. Maybe you purchase on a weekly basis. Maybe in a space of a month, we have done purchases more than 5. But what does it mean in terms of the valuation method? It says that whatever stock that manages to get into your warehouse must be able to be sold first. Must be able to be sold first. So if you purchase for this week and purchase next week, while that your previous stock has not yet been finished in your warehouse, you must first start selling the inventory that has been managed to purchase first. The term first in, first out is trying to simplify that. And we call this is a method of inventory valuation. The second valuation method is just the opposite of the first one. We are saying on this one is a last in, first out method. What we are saying, the last component that is managed to reach your warehouse must be the first component to be sold. Hence, we call it is a FIFO method. We've got LIFO, hence we are saying it's a LIFO method. We've got FIFO method and LIFO method. The last one is an average method. Average method basically is a mathematical division of your units so that you know what is an average unit in terms of your average cost price per unit. These are the methods that you must be able to understand to make sure that you've got a better understanding. You can be able to know the characteristics. If you are given a scenario, you can be able to say this is a first in and first out method. This one is a last method. This one is an average method. We'll do the practical part later, but this is a theoretically format to say if you are being requested to say what the inventory valuation method you need, we are expected to articulate the three, but understand what is first in, first out means, last in, first out means, and the weighted average. So these are the evaluation methods that are being used in the business sector. Critically, also, there is an issue of the depreciation. This one, I think we've touched indirectly in terms of the previous session to say we define what the asset is, but the reality of the matter, asset has its own life, you know, so the estimated lives. But in order for you to asset is losing value, there must be a systematic way of doing that. We call it a depreciation method. We call it a depreciation to say if you got a vehicle, that particular vehicle, it loses value, but we attach a particular percent to calculate the depreciation, and we call it that effect as a depreciation. A depreciation of the asset is so much based on the percentage that has been agreed by the management or by the management of the business. Depreciation has got various methods. It's got various methods. We've got a straight line method. We've got a diminishing method. I will explain what is a straight line method. A straight line method, for example, let us put an example so that we can be able to understand that. You've got a vehicle of 600,000, a vehicle of 600,000, and it has been agreed that this particular car, will stay plus minus 10 years. Plus minus 10 years. So if you are required to calculate a depreciation using the straight line method, what will be expected from you? Let us say we've got a very good Mercedes-Benz, and the company estimated that this car will only last for 10 years. So now I'm asking to say, if we are being asked by auditors to say, what is the depreciation of this car? Now you argue to the auditors to say, no, this car is depreciated in a straight line method. Now the auditor is requesting for you, what is the depreciation value of this particular car per year for the first year? So the value of the car is 600, depreciation is a straight line method, and the lifespan of the car is 10 years. What could be a depreciation per year?
60, I think 60 rand.
Others say 60 rand, and others?
Sir, please repeat the question.
Let me just write here so that we able to participate in a fairly so the 10 years. So the 10 years, then what is the yeah, I'm trying to simplify this. We've purchased a vehicle at 600,000 in our own business. And the lifespan of this car is determined by the management. It says 10 years. Now, I want to know a depreciation per year. We are using a straight line method. What is a depreciation for year one? Any attempt? I know we are lawyers. The matter as part of your attorney firm, you have cars. And if you buy a car now and you decided to sell it in the next 2 years, you want to sell it with, obviously it loses value. But from the accounting perspective, we must attach a science. And the science that is being proposed on this one says that and the depreciation, and we're using a straight line method. Now I'm asking, what is the depreciation for the year one?
So can I attempt this one?
Others are advancing 500,000 depreciation. Others is advancing 60,000. Third one.
5,000.
5,000.
So the amount is 60,000.
Thank you very much. I think 60,000 is dominant. I fully agree. But in a simple way, if you want to know how much the car is losing per year, you can simply say 600,000 divided by 10, which is the number of years. Obviously, the depreciation will be 60,000. We call this method as a straight line method.
Sorry, sir.
Yes.
If it's 10 years, do we divide by 10?
Yes.
Because 10 years has 100 and... Okay.
Yes. For example, I know where you're going. For example, I'm looking for a depreciation for year one. So year one, 60,000. So this car is losing a value of 60,000. So if I decided to sell this car after year one, how much money of this car do you think I can sell out? I use only 1 year. Then when I start the second year, I decided to sell out. How much money?
540,000, sir.
Great stuff. Meaning that at the end of the year one, the original cost is 600,000 minus
600,000
minus 60,000. Then you've got just wait a moment. You've got 540. So your value of your asset in year one at the end of year one is at 540. Is 540,000. Why is it 540,000? It's logical that we have used your car for the whole year, but you also attach a depreciation value of 60,000, meaning that if you decided to use this car for a year and sell out to the second year, you'll sell it at 540,000. We call this 540,000 as a book value of the asset. Are you following, guys?
Yes, sir.
Yes, sir.
Let us change the story now. Let us change the story now. It's the same value of the asset of 600,000, but the depreciation this time around is 10%. And it's 10%, and we are told that you must use the straight line method. What do you do? It's 10%. It's 10%, we are told it's 10%.
It's gonna be 600,000 multiplied by that 10%, which will give us also 60,000.
Which will also give us 60,000. I'm in agreement with that. But what I want to make sure that you understand, there are various ways of asking similar different way. But if you are told that the depreciation is expressed at 10%, you must know that we are expected to. So what do we call this? We call it a straight line method. So keep in mind these figures. Keep in mind these figures because we are going to the second method. The second method, we call it is a diminishing method. Other people will say it's a reducing method. What is a diminishing? What is the difference between straight line method and the diminishing method or reducing method? What it implies? What it implies? A diminishing method or reducing balance method is the same thing compared to the straight line method. Let us do a practical example also using the same examples. So if we are told that calculate your depreciation year 2 out of these 10 years, year 2 now, this time around. Calculate depreciation using a diminishing method. Thank you very much, Tabane. That is exactly that we want to practicalize. Can we attempt this one? The value of the car is at 600,000. The percentage for diminishing is at 10%, but we are required to calculate for the year 2 the depreciation at year 2 using diminishing method or reducing method. What do you do? We are calculating now for year 2 depreciation using a different method, and we call it a reducing method or diminishing method.
Excuse me, sir, can I just ask a question quickly? Do we
Yes, please.
Do we take the beginning of the year's book value, which is the 450,000, to calculate the year 2 for the diminishing value?
Yes. Look, all the scenarios remain the same. I'm saying that the value of the car is 600,000. The lifespan of the car is 10 years. But the question now, it says that calculate depreciation using a diminishing or reducing method for year 2.
I think we'll have to find the 10% of the 540,000, which is 54,000 rand, and then we subtract it with a predict on 540,000 minus 54,000, which is 486,000 now on the second year.
Yeah.
So I can see there's some suggestion on the chart. Others say 54,000. Don't worry, Pam. We are coming to you.
I agree, sir, with the guy who just spoke now.
Yeah. Remember very well, we are going to year 2. The year 1 was 60,000. In order to kill this method, it says a diminishing, and this diminishing or reducing you must see in practice. So you've got 600,000. What is the depreciation from the year 1 is 60,000. Then you've got the value of 540,000. Then again, out of this 540,000, you address the issue of 10% as a diminishing method. Then the issue of 54,000 is 100% correct. It's 100% correct. Do you understand the straight line method versus the diminishing?
Yes, sir.
Okay, so we calculated for year 2. Let us calculate now year 5. Same figures. Calculate for me depreciation using diminishing method or reducing method for year 5. Few minutes.
$48,600.
Just wait a moment. Give me that figure as an option 1. So we've got first figure here is 46,600 is being supported, that one. Another one.
Not 46, 48,600.
Okay. I'm still waiting. Okay, thank you very much. Let me just and try to simplify for this. Is it year 1 or for diminishing is what we already calculated actually. Yeah, just wait a moment so that my answers can also be reflected here. Is it minus 60? Minus 61, which is at 540. Is it year 2? $540. Minus 54. One, two, three. People, it seems, get tired in year 3. We are going to we are going to the 46,000 at 486 actually is at year 3. Where's year 4? Where's year 4? 486. 486,000. 486,000 is under year 3. what is a year 4? Tabare. What is a year 4? I'm in agreement with the Tabana. So you must make sure this one is little bit tricky. That the asset is in existence for 5 years, but you are required to take into account in terms of year 4. But make sure that all these accumulative figures you are able to take into account. All these accumulative figures you are able to take into account. So you must make sure that year 1 is so much, year 2 is so much, year 3 is so much, year 4 is so much, year 5 is so much. And we call that is an accumulated depreciation. You need to be very careful, because in terms of your exercise will always take that shape. It's not really straight, but thinking around that, you understand the principle of doing this. You understand the principle of make some calculations. You understand the principle of disclosing these issues, you know. So this is, in terms of principle, Tabano, you're correct. Make sure that there's a proper accountability in terms of year 1, year 2, year 3, year 3, year 4, year 5, and so on, up until your asset, it reaches a zero balance. So that is the only distinction. Once it says straight line method, you can. Once it says diminishing, it means you need to take into consideration your previously calculated values in terms of your depreciation amount. So we call these, when you talk about the reducing and diminishing, you must know that it's the same thing. It's the same thing. Then in terms of your calculation, your debit and credit, depreciation will be an expense. You got the debit balance, then accumulated depreciation in terms of those adding up, summation would be your accumulated depreciation having a credit balance. So you'll be able to address these accounting procedures in that context. So before we proceed to issue of the bank recon, is there anyone who would want to be assisted in terms of this method, depreciation methods?
Yes.
We have better understanding. Your hand is up. Can you chip in?
Yes, sir. I just wanted to ask, with our unit notes, we were told that depreciation with the reducing balance has its
Yes.
advantages and its disadvantages.
Come again?
We were told that the reducing balance depreciation has advantages and disadvantages.
Yeah, you see, hence I'm saying these are the two methods.
Yes, and my question
but we're expected to select one method. You can't use the combination of them.
Yes.
You understand?
Yes. And my question is, one of the disadvantages was that our carrying value cannot be zero. Do we not want to have the asset under the asset in our record for as long as possible?
Let me explain why do you come around with zero. Let us use the diminishing method, for example. I will explain that one is possible. If you look the example that is being articulated by vendor, if in year 1 we are told that calculate depreciation using 10% using a diminishing method, we don't have year 0. You will have 600,000 minus 0 because we don't have year 0. You only have a figure after you proceeded to. But if we are told at year 1, you've got 600,000 of an asset, then you are required to calculate a depreciation using a diminishing method. You will have 0 because you don't have, you will have 0 balance in terms of the previous year, because year 0 you've got nothing. So in that context, you'll act like as if you use a direct method, but in essence, there's nothing you can subtract at year 1 because you don't have year 0, but you're going to have apply a depreciation method to the subsequent year simply because the first year you've managed to incur. But if in year 1 you don't have a car in the previous year, therefore the issue of the diminishing is not, we've got a 0 balance in that context. So the value of straight line and diminishing will be equal. Will be equal in that context. Do we get the logic? You only have an accumulative depreciation provided your asset is managed to sit a period of 12 months and you are required to calculate the depreciation of the subsequent financial year. You see?
Yes.
So
Yes.
In that context, but the issue of advantages and disadvantages, it will depend. It will depend in what context. If you have an asset and less depreciation, it means this is the value of the asset what you have. So if you use a straight line method to calculate depreciation, for example, for year 2, and notice that now your current value is 60,000 minus 60, 600,000 minus 60,000, you've got 540. So the value of the book value of your asset is at 540. But if you're using diminishing, so if you're using diminishing, you will say 600,000 minus 60, you've got 540. 540 minus 540 times 10%, you get a percent, then you aggregate them, you minus, obviously the value of the asset will be lesser. Therefore, if you want to say which one was better, you focus on your straight line method, because the straight line method is actually giving you higher book values. But at some point, it depends on how your asset is being used. That is another factor that also be taken into account. For example, a car that is sitting in a garage for a year, it does lose value to a certain extent, but it's not equal for the car that is always on the road, whether it's using 10% straight line or diminishing method. So there are so many factors that you also need to take into account if you want to resell your car or to dispose your car. So the issue of value or disadvantages versus advantages is a very subjective matter, Hence I'm saying other people are using mileage. Let us look the mileage. Other people are using their service plan. Other people are looking at the history of the car where there was not involved in an accident. You see? So the issue of 10 years or 5 years, it depends, it depends about what the organization agreed upon in terms of their own assessment. The issue of depreciation is not constant, it's not the same. Like a depreciation for building, land and building, is not sometimes, they use a valuation method to deal with those. Then the depreciation for computers sometimes is not the same like car. So this is an accounting policy issue that needs to be decided by the management that will be depreciated for the financial period at hand. But in principle, if I'm happy if you what depreciation do we have in business? We've got straight line, we've got diminishing or reducing method, and how is being applied. And how is being applied. That one is the most critical part, because other organizations will say you already have a depreciation for the previous 2 years. So you've got an opening balance. What about the third year? Then you must able to make an application in that context. Siyavana Pam.
Oh, I will say thank you.
Yeah, but I like your guide is very explicit to be able to follow, but just capture the principle, you know, this one for another level is quite critical, because if I want to be look like my business is rich, I can lower down my depreciation values to put at 5%, so that I can be projected as my book value are too high. Hence, it's always key to even to go to the market to say, really, this particular asset should really value this particular figure. You know. So just understand the principle around that, because for now was not really about key accurately, but understand the principle first, how to approach it. Then you do your own calculations and repeat up until you understand. But what was fundamental, understand the principle around this issue of depreciation. Let us just now engage on the issue of a reconciliation. The issue of reconciliation, we've tried to spend. This one is demanding in terms of your practice, but it's important that to outline the necessary foundation. In business, you know, we've got somebody that is responsible for receiving money, you know, keep our own money in safe, doing our own records. But the relative of the matter, we do bank this money in a particular day, whether it's banking to FNB, banking to ABSA, it depends, you know, the business of about which bank the business is using. But challenges to this, our books are not always agreeing up. And it's always practically. Are not agreeing up in what context? The information sitting at the bank in the form of bank statement is not the same with the information that we have in the business side in terms of what is, you know, the accountants that are the custodians in terms of your cash. If those your differences does exist in business, we have a responsibility to do what they call it as a bank reconciliation. Bank reconciliation, by its own term, you can see you reconcile something that is not in agreement. So this particular component, we want to articulate, you know, around that, you know. We want to articulate, you know, to say why bank reconciliation is important. Bank reconciliation is important because certain customers doesn't come on the business side to pay the product or to pay the services. They go direct to the bank using the references of the business to say, I want to pay this. This is the reference. I'm paying for water, for example, the municipality. You are not going to municipality, you're going to the bank. Reality of the matter now, it means what has been deposited by you at the bank, you won't reflect to the business, to the books of the business up until we are doing a reconciliation. Another practical example is like insurance. Insurance does not make deduction to the bank, to the business. They make deduction to the bank. But the business becoming aware in terms of the cost that has been paid in relation to the insurance by simply drawing up the bank statement and do some reconciliation. So when you talk about the debit orders are done at the bank on behalf of the business, but the business are not aware of such time that the bank reconciliation is being done. So I'm trying to articulate around what are the grounds why the agree. This is a summary of the issues. Like outstanding checks. These are the checks issued to suppliers during the bank statement period, but have not yet been presented to the bank. So what does it mean, this rule, this one? This rule that it says that you've got a business, you've got a business, but there are certain issues that you have to pay over to suppliers. Instead of paying in terms of the EFT and cash, you decided to make the payment through the checks, you sign up the checks. So if the check has not yet go to the hands of the bank, it's still at the hands of the suppliers, it will not be reflected to the bank, but it will be reflected in your books as a business. So that is another disjunction. So you've got outstanding deposit. Outstanding deposit, what does it mean? Let us say, for example, you've got a responsibility, whatever the money that comes in to your business, in a subsequent day or following day, you take it and deposit to the bank. But this time around, the 31st is on Friday. Somebody comes into your business premises or to the municipality to pay water, and they pay water before 3:30. They pay the water before the 3:30. Then you record that amount in your own books. Remember, a bank statement runs for a period of 30 days. Then in a subsequent month, you decided to draw the bank statement, which is the following day. It means the amount that has been deposited in the business site in terms of your cashier, it won't appear in your bank statement. So that is a second contributing factor to make sure there are imbalances, there are disagreement between your books in the business site versus what has been reflected in your bank statement at the bank. The third ground, or reason is issue of a direct deposit. I think this one I am able to articulate. If someone decided not to come to business side, going to the bank and use references, it means there's no way that you'll be aware about that deposit. It means it won't appear into your books, but will appear in the bank statement. So it's another ground that necessitates reconciliation. The third one, the issue of bank charges. Bank charges are being, imposed by the bank, obviously. But the transaction relating to bank charges, you're only becoming aware when you download your bank statement. Even this one is another contributing factor, equal to apply on the issues relating to bank overdraft. So these are the grounds that are important for us to make sure that we have a full understanding. We have a full understanding. In reality, these two businesses, the bank versus your own businesses, they are overlapping in terms of transactions. Therefore, it will necessitate to do a bank reconciliation at the end of the day. These are the other matters that can be, reflected through the bank statement, but not reflected in your cash book or your cash receipts or cash payment journal in the business side. These are the I can see now we have been joined by other participants now. We've been joined by other participants. At the right time, those participants will be allowed to participate. But for now, can we be allowed to engage? yeah, at the right time, we'll allow those participants to be part of us. Then the bank reconciliation, when you're doing bank reconciliation, there are certain steps that you need to follow. It's not done in a haphazardly way, but there are certain logic steps to follow when doing a bank reconciliation. One of the issues I indicated that mostly been recorded in your business site in terms of receipts and in terms of payment vis-a-vis your bank statement. Then you're doing a game of ticking what is there, what is not there. Obviously, the step 2, you look what's supposed to be received by the bank. Can we be assisted, Williams?
Out.
Let me try to disable this one. Yeah, thank you very much. These are the steps that I highlighted in respect of the bank reconciliation. You follow these steps, but critical to that, we must find a way to do some practical exercise in that context. But majorly, we've got 5 steps under the bank recon to make sure that we follow them. But there is no other way of understanding the bank recon except the practicing of it. But these are the steps that would be your maximum on this in terms of your articulation. We have to go and read all the examples that are part of your pack relating to bank recon and relating to the bank recon, because this one is a little bit longer in terms of the methodology. They are not shortcut, so we'll be required to follow these steps. So read these steps 1 to 5 and map it to your guide and try to understand what does it mean. Probably in the next session we should have to engage on that. At the present moment, I want to stop at this slide and allow a student to raise anything in relation to the subject matter from now up until 1845. Anything from slide 1 to slide 2. If you want some recap on that or you want some clarity on that. From slide 1 to last one, it doesn't matter.
Yes, I want to be assisted on the vet one. I think the input and the output one is still challenging for me to understand, even or rather given the example that you have given of me standing in the middle. Yes.
Let us do this way. Let me just quickly log out and share the study guide so that I can zoom in and do other examples which are there so that you can be able to do it in your own. Let me just go this. Can you see my kite?
Yes,
Yes.
sir.
Yeah. Others, they must still prepare their own issues. So for now, let us go to the VAT one so that we can simplify this. VAT is on page 30. VAT. I'm just looking something that's got a definition. Okay, can you see this example? The guy raising the issue of the VAT.
Yes.
Thank you very much. You see the best approach to understand this thing. I said you must visualize yourself as a business person. Let us say you are the owner of this retailer. Can you see the retailer is at a center?
Yes.
Is at a center. But for you as the owner of this retailer, you must purchase from here to the producers. And your producers is your suppliers. You can see this one.
Yeah.
In your left. For you to be able to sell your product to the customers, your customers are here. Okay, the final consumer.
Yeah.
Are here. Now, the argument on that, let us assume that your retailer, we are VAT vendor.
Yes.
The producer are also VAT vendor.
Yes.
Right? Now, in order for you to sell these products, you approach your suppliers. Your suppliers are telling you, look, I'm a VAT vendor. I'm selling my product at 1.6. Can you see?
Yeah.
At 1.6. But simply because now I'm a registered VAT vendor, I have to charge you 15%. Do you have a calculator with you?
No, it's a phone.
Do you have a calculator?
No, it's a phone.
Calculate 1.6 times 15 divided by 100.
It's 240. 240.
You managed to get it.
Yes, 240.
That 240 is a VAT, is a VAT. Meaning that if you add 1.6 plus 240, you can see it's written here, but I was trying to make sure that you understand the dynamics. So
yeah.
You, instead of buying at 1.6 product at 1.840 at this is a selling price that you've purchased this product.
Yeah.
This product is inclusive of that of 240.
Okay, yes, yes.
Now, you see this arrow. Can you see this arrow?
Yes.
It means now you have taken these products coming in to your retail.
Yeah.
You see?
Yes.
When this product coming in to a retailer,
Yeah.
it comes at 1.850 at this one. You see
Yes.
this one?
Yes.
Simply because now you are in existence to resale. Right? We are in existence to resale. As
Yes.
part of your reselling, we are also a VAT vendor. Calculate 15% for this figure for me. How much?
276, 276 rand.
Meaning that your selling price now to customers, you add this, then you get this one.
Yeah.
Is either now this your customers are spaza shops or are your general public are buying this product at 2,116. But if part of your product still have to resell it again, they will add another VAT. But for now, for your own understanding, make sure these blocks, you put yourself at a center.
Okay.
You put yourself as a business person at a center. And now, to me, to simplify this thing, I always say, if this arrow comes this way, it means it's coming in. See, it's coming in.
Yeah.
Then input VAT. Then it's going out, then output VAT.
So
don't add another block here and another block, another block. It can be added, but it's not a responsibility. But when we are here,
no, I understand.
Now, tricky part now is that for your own accounting perspective, let us say you are not given this and this. We are given the selling price. We are required to calculate the cost price. So that would be another dimension that would be able to look at. Do it for me because we want to apply at this stage now, this one.
So I need to find the 15.
We are given with this one only, but the question says calculate the cost price. What do you do?
It means that I must find the 15% of 1,340.
How do you do?
From my thing, I'll say 0.15 times 1,840. But I'm not getting there.
Yeah, try it. Because you must understand this figure is at 115, this one.
Yes.
This one is at 15. This one is at 100.
Yes.
So now, for your argument's sake, if you say you have been given 840, you want to calculate the cost price. 1,840 times 100 divided by 15, what do you get?
It's what?
1,840 times 100 divided by 15.
Divide by 15.
Divide by 115, I mean.
1.6.
You see those dynamics?
Yeah. Oh, okay.
You see those dynamics? Let us reshape the question now. We are given, again, the same figure. You are not given the cost price. You are not given the VAT amount. Let us calculate VAT. We have been provided 1,840, but the question says calculate the output VAT.
Yeah, I don't know the formula.
You don't know the formula. Let us say 1,840 times 15 divided by 115.
1,840 divided by what?
1,840 times 15 divided by 115, 115.
$240.
Yeah, you see, so you must also try to capture those dynamics. You know, you can be provided cost price, not given VAT. You can provide a selling price, not given cost price, but you should be able to do that. I think this slide, this one, is trying to articulate the dynamics. You must understand these dynamics very well.
Yeah,
very
somehow,
well.
I did not understand what was. I will just read, but I will not understand. Yeah.
Okay.
Yeah.
Let us analyze this one, recording in financial records. Recording in financial records. Remember, we'll link this issue. I like how your study, your guide is being simplified. You see, if you've got a VAT receivables, it means that you've got a responsibility to claim this 240 to SARS, and under your current asset, you will have a VAT receivable component, and it would be your asset. But if you look here, this 1,840 is at suppliers, is VAT inclusive. Once it says VAT inclusive, the issue of 240 is part of this amount. You see the dynamic of VAT input of 240.
Yeah.
You see, it says VAT input 240. Why is VAT input? Understand that according to this diagram. Put yourself here and look, your arrow is in your business. This one is out in your business.
Yeah, no, I understand now.
Don't enter too many blocks. These three are sufficient. So you will see. Then in terms of your recording, you can see the VAT component is here is 240, but what has been going out from your bank was 1,840. That 1,840 is VAT inclusive. You see. So this is how you record. I think this one is just an articulation in terms of, what are the bases for being liable as a VAT vendor. You can articulate those issues. Then the results of output and input we articulated. That is where you know that you've got VAT payable or VAT refundable. If it's refundable, it's a receivable. If it's payable, you know that it's treated as a creditors under your current liabilities, this one.
Yeah.
So just go through with it. Don't take into account the new development in terms of the VAT rate in South Africa. Just stick to 15% for now.
Okay.
Let us go to another period. Want us to put more clarity? I don't mind regardless of the slide page. I'll go. Yeah, your slide is, to me, the UNISA has tried to simplify as much as you can. Go through the slide. I don't mind in terms of where your study guide, but which part you want to engage. The depreciation issue, you can see here is simplified as well. The VAT is what we articulated. The basis for calculating for VAT is invoice basis and the bank record in terms of this as a study unit. In terms of this. So go through and I will encourage this teamwork, you know, and try to participate with the WhatsApp group and make sure that others are able to articulate and explain to others where we have some challenges we can explain. Even myself, I'm participating on that. If I have time, I can be able to assist, but I'm also a worker during the day. I've got certain issues to attend, but if I have time, I can be able to assist the process. But I do encourage that students must just work together. I think critically, if an assignment is open in a 3-day period, try by all means, if you miss day 1, but day 2, complete your issues. Complete your issues. Make sure that you derive time to assist the process.
Yeah, because this study guide, it is very fine, but then when you are reading it alone, and especially as you don't have the background of accounting, it becomes very,
I can see it's very summarized.
Yeah, it's very summarized, but it can be challenging.
Yeah, it's very summarized. But I've tried by all means to make it simple. Yeah, it's very summarized, I can see.
Yeah, because now if you can look at the recording of the inventories, I think Leon, that one is very challenging. Page R12 there. When recording about the periodic and the perpetual ones on this slide. Well, we can read and see, but without explanation, it becomes very tough. And the thing is, other lecturers are different. With you, I think like I understand best. With others, I'm like, hey, I try, I get them, but the articulation is not the same. So I think, I think now what is far from my grasp is just the recording of the inventory. If you can go to page 10 or 11, 12 of this very study guide.
Page 12.
Yeah, go to page 12. But I think it will take a lot of time. I don't know if other students.
Don't worry, we'll simplify. Page 12.
Yeah, so
this one.
It's 12. No, it's page what? This one.
I'm still on page 1. My page 12 is not reflecting as yet.
Yes, so this is page 12.
No, this.
So you can see page 12.
Yes.
Yes.
Let me simplify this one. I like this one. Let me simplify this one. Let me simplify this one before we finished. Think about yourself that you are selling water pumps, right?
Yeah.
You are selling water pumps. You are selling water pumps. It means if you are selling water pumps, you receiving, you remember that block's got 3 blocks, we are at a center. You don't make water pumps, we are selling water pumps. Meaning that you have to engage your supplier who is making water pumps. So on the 2nd of February 2026, you receive 10 water pumps at a value of 1,000 each. Can you see that?
Yeah.
In terms of your recording, you are using perpetual. You can see the receiving column, this one.
Yeah.
This one. You're recording these 10 water pumps. If you say 10 times 1,000, how much?
10 times 1,000 is 10,000.
This would be your balance, this one. Can you see?
Yes.
Yeah.
Then let us analyze number 2. You see, on the 3rd of February 2006, you saw pumps which are 5 in total. Can you see this one?
Yeah.
It says inventory sold. Inventory sold. So if you still have that map in your mind to say we are at a center, meaning that this aspect has been delivered by the supplier to your business. But when they arrive in your business, you've managed to sold out 5. You've managed to sold out 5. So if you say 5 times 1,000, how much do you got?
5,000.
This is your 5,000.
Okay.
This is your 5,000.
Yeah.
Actually, this is your 5,000. Meaning that in simple terms, when these products, which are water pumps, arrives in your business, we've got a balance of 10, which is 10 times 1,000, which is a 10. Now, on the 3rd, you sold 5. 5 times 1,000, you've got 5,000, hence it's got negative here. So in your cost, you've got a minus, which is negative. And the balance that is remaining, it means on the 4th day of February 2006, you've got a balance of 5,000.
Yeah.
Let us go to this one again. On the 6th of February 2006, there is another arrival now of 8 water pumps at a value of 1.1 each. You come here, you can see on the 3rd line, 8 times 1.1. How much 8 times 1.1? How much if you multiply these ones?
8,800.
You can see you've got 10 minus 5, but now you've got an addition of 8.8. This one. Can you see? Remember, before you take out 5,000, you've got 10, then you less 5, then you remain 5,000. So if you take 8.5 plus 5,000, how much do you get to get a balance now? So that if you open on the 7th of February, how much for your 8.8 plus 5, how much?
30,800.
This is your balance.
Okay.
You see?
Yeah.
Let us go further. Let us go further. So on the 16th of February 2006, you sold out 4. Now, you sold out 4. Think about on this one, Beno 4. And the rate is this one. How much? We will say 4 times 1.1, you get the total. 4 times 1.1, you get the total.
So, but then
Sorry, I'm
in
lost.
page
What?
13, on page 13, it says 4 times 1,000, not 4 times 1.1.
Oh, this one. Yes. And the critical to that, what you must understand, your previous balance was 13 we were 5 plus 8, we got 13, but now we are selling out in terms of your middleman, at the middleman, but you only sold out 4. It means now out of 13, you also need to consider your units. 13 minus 4 will be 9. So you left with 9. But critically, you also take into consideration your balances. Out of 13.8, now you 8.
Mm-hmm.
Then what is important? Understand what is the meaning for this column. This column is out, this one. This column is in, this one. It means all these ones, your suppliers has managed to supply you with the necessary stock. But these ones, you've managed to sell out to the general public. Hence, there's this one and this one and this one. Can you see? It's heavy, no?
It's so heavy.
No, like some ways 1,000, the other is 1,000.
That's what I don't get. It's same. Like in that column next to balance, there by the transaction of the 6th, there's 5 times 1,000, then there's 8 times 1,100.
Which one now? That one?
You see on the transaction of.
This one.
The one for the 6th February 20.6. The last one, exactly. That's one that you are pointing. 5 times 1,000, and there's a plus outside of the bracket. Then it's 8 times 1,100. I think that's where the confusion starts. That's what they are referring to.
Just wait. Or the last one.
Yes.
Let us analyze from here. $26 is in 1.2. Would be easy to get it, my brother. So if say for 1.2 times 4, how much? 1.2, this one, times 4, how much? 1.2 times 4, how much?
Sorry, sir, I think you've jumped now. You've jumped. We are referring to the one for the 6th February 2006.
Like the last transaction on page 12.
Yes, on page 12.
You see page 12, like the last one there.
The last block.
This one.
On the 6th February, so yes, that's one. That one you pointed on top there.
Or this one.
The next block. The last block.
This one.
Yeah.
Yes.
Yes.
Actually, where they are showing how they got 13,800. The last one where they say 5 times 1,000.
No.
8 times 1,100.
No. Don't go to that extent. These are just their own workings. But for you to simplify it, let us understand this one. Let us just start from the first line up until this one. This one is just their own workings. We agreed that these pumps were purchased from suppliers at 1,000, which were 10 in total. They gave us this amount. You agree on that?
Yes.
Yes.
Then on the third, because we've got 2 critical columns that you must have effect. Is the column of the units at hand and the balance. Column of units at the hand and the balance. So we are saying on the first, we don't have previous units. So this 10 units took as is. But in terms of the cost is at 10,000. We agreed on that. But on the third, we've got a minus. But this minus, we've got a minus of 5 units. But the units at the hand, how much? It's a 5 minus, it's a 10 minus 5. We've got 5 units at hand. Do you agree on that?
Yes.
Now, the issue of units, we've managed to clarify this one. Now, what is outstanding now is to clarify the issue of balance. These 5 units are costing how much? These 5 units are costing 1,000 each. So if say 5 times 1,000, you've got 5,000. This that we have. But this 5,000 is no longer for us. Is this 5,000 is no longer in the bracket of a cost. It's minus. It means what we have in the cost in the warehouse is lesser by 5,000. Then your money now that has been remaining after you have deducted the 5,000, the 5 units in terms of 1,000 each, you are at a 5,000 remaining. But this 5,000 remaining is not automatic. You look at what was your opening balance minus this negative. 10,000 minus this negative, you're left with 5,000. You see, it's this balance that we have before you do sales out of 5, which constitute 5,000 in total. You say 10,000 minus this is what you have now. 5,000. This is your balance now. It's no longer 10. So let us carry on. You see now on the 6, instead of selling out, you've got new incomings now. These new incomings now, they are 8 in units at the value of 1.1. Now, before you address anything, you need a balance. The balance that we have in terms of units is 5. Balance that we have in terms of units is 5. Then 5 plus 8 that has been arrived. What is your units at hand? 5 plus 8. The units at hand, it means we've got 13. You know that your previous units that has been remain were 5, but out of these 5, we've got new additions, which were 8. So 5 plus 8, you've got 13. Hence, you see these brackets. Can you see these brackets? Are your workings this one? Just to clarify, how do you arrive to 13? So now we are done with units, but we're not done with money. We are done with units, but we have not done with money. So the units, now we need to translate these units into full values. 8 times 1.1, then you've got the cost of 8,800. But this is not your balance. This is not your balance. Now, hence you add this 5 plus 8. You also need to add 8.8 plus 5,000, which is your previous balance. This figure and this figure, what do you get? This 5,000 plus 8.8, this one. How much?
13,800.
This is now your new balance. Don't bother yourself with this one. This one will confuse you. These are your calculations. But in reality, you must be concerned with the units and be concerned with values. Just like if somebody is selling weaves, guys, if you've got a salon, you've managed to buy these weaves in China or in Brazil. We are selling these in East London, but out of 10, you've managed to sell out 5. at the value of 1,000 rand, then what will happen to your stock? It means you have remained 5 as shekel. And if you are told to cost how much the cost of the weaves as a shekel is E5, but inye is 1,000 rand. So 1,000 rand times 5, it means we've got a balance of 5. But you decided on the 6th of February to buy weaves. 8 weaves now in Korea at 1.1 NAS. So Ubuno 5 is 13. But the cost here is 8. Is 10 in Korea. Zenza 8.8. Therefore, in my stock, mazofika umhla 7. This is the 6th of February. Fika umhla 7. This is the stock that I have. I've got 13 issues. Kufika 8 in terms of it cost 8.8, but the total of the 13,800. It means from the 7th of February now, you are expected, if into zakho zingathengwa zonke, you will realize 800. It's still heavy?
Yes, sir. No. It's not heavy. It's lighter now. Lighter.
To simplify, but that is the logic you will do that. Do you understand? But what is important, deal with the units, because the only impact that is there, that they are new arrivals, they are those ones who are sell out. What are the implications? And what are of units?
Thank you, sir.
So let us and then we will see. But in the meantime,
I think says muted his mic. So you're muted.
Sorry. Thank you very much. Thank you very much for the participation. That's what I was indicating. Thank you very much. We can read and read and that, and you will understand. But again, feel free to engage me. And I like this practical example. You can see where you got a challenge. Then you, before we finish up.
Sorry, so before you run away, can we go to page 13, please? There's something that I didn't understand.
On which page?
Page 13, just
page 13.
Underneath this one, yes.
Page 13.
Yes, hold it there, sir.
Which line?
The line of that 2,200 on the 22nd of February, 2026.
This one?
2006. Yes. Where did they get that 2,200? Because to my understanding, if we are talking about 5.4, we said it's assumption. We are assuming that whatever we bought it first, we'll sell it first. Am I right?
Yes.
So if that's the case, after selling, we have one that is left. That is for 1,100. If you are from the 16th up to the 22nd, because there we get another stock which is for that water pump. Then we sell there. Then we are left with 2, but they are from different. The other one is for 1,200. That's my understanding. I might be wrong. And the other one is for 1,100. So if you are selling, that means you're going to start with the one for 1,100 before we go and sell the one for 1,200. So where did we get that 2,200?
Let us just proceed on this one up until we arrive to that one. Let us do the 16. So you were here now, my brother. You were here. We are saying on the 16th of February, there's a sale out of 4. Let us go. This is a sellout. Now we agreed we need to be principled in this process. In terms of the units that are available now are 13. Are this one 13?
Yes.
Out of these 13, we have sold out 4. So 13 minus 4, how much remaining? Is 9.
It's 9. Yes.
You are in agreement with that, ne?
Yes. And then yes.
You are in agreement in terms of units. Now these water pumps are 4. How much each?
The 4 that we sold, each it's 1,000. That means all 4 of them will be 4,000.
Yes.
Then it will be 13,800 minus 4,000 will be left with 9,800.
Yes, yeah. Just wait for that. You done very well. I'm in agreement.
We are still left with 1 pump. That is for 1,000 and the others for 1,100, if I'm not mistaken. But we are left on those for 1,000. We are left with 1 pump because we already sold 9 now of the first in.
Yes, yeah. Just wait a moment. So we agreed. We are fine for this.
Yes.
Let us go on this one on the 22nd now. On the 22nd, and you need to be critical to say, out of this 10, 9 has been out. Out of this, 9 has been out. Now we've got 7. We've got 7 that were sold on the 22nd. Let us do the mathematical issue now. Out of these 7, which one let us just address the unit first so that we stick on the principle. We agreed that 13 minus 4, we've got 9. So we are 9 that has been left, but out of this 9, we are taking out 7. We agreed, then we're left with 2. Yeah. Let us do this one now. Out of this 7, 6 qualifies as 1.1.
Yes.
One qualifies as 1,000 rand. Do you agree on that?
Yes, we agree.
Let us do the mathematical part of it outside, not this one. You say 6 times 1.1. How much do you got?
6.6.
6 point?
6.6.
Yeah, put it separately, my brother. Put it separately.
Yes, I put it separately. 6.6.
Yeah, then take 1 times 1,000.
1 times 1,000 is 1,000, which will be 7.2 if we add them together.
If you add together, how much do you got?
If I add them together, 6.6 plus 1,000, it's 7.6.
7.6.
Yes.
Yes, 7.6. This is your value. You see this value?
Yes, the 7.6, I see it there in bracket, yes.
And is it negative? Now, you say 9.8, which is your balance, this one, minus 7.6. How much do you got?
2.2.
This is how you arrive on this figure. Can you see now?
Oh, yeah. That's why I got lost. That's why I got lost. No, thanks a lot, sir. Now I see it.
Yeah. These busy columns, don't worry about these ones, this and this. Just do your own mathematical in a separate part.
Yes. No. Now I get it where they got that 2.2. Because I was confused. Where does that 2.2 come from?
And I like your input because if you look at this, definitely it's a first in, first out. It's a FIFO method. Thanks, man. Thanks. Thanks.
I have a request,
Sure.
and not try to be funny, but you know, when lecturers are trying to summarize these things, you guys are not the same. Because I don't have background in accounting, but I tend to understand you better. Last time we were doing chapter 1, you promised to come back to us to do that T double what system, and you didn't do it for us. But if possible, can you maybe see us twice a week? Because Aziz is good, but like in school, it's not all teachers that are teaching the same. There is a person that you understand more better than the other. But when we are explaining, I tend to understand more better than when Aziz do, because I end up getting more confused. So my request is, if possible, can maybe you get 2 slots like she does? Then I know that if I get the basic from you, when I go to her, it tends to be easier.
Yeah, probably you can submit a request to the varsity, because we are independent contractors to assist the process, and our approach, I'm allowed to meet once with this particular module. I'm not sure the possibilities in terms of meeting twice and so on, because we meant to augment the processes that is being offered by the lecturers. But we have no problem, you know, to do that if varsity, you know, make a provision for us to deliver on that. But you see, not all of us, we are multidisciplinary approach, because I have a little bit of law. I've got much advanced part on the accounting and auditing side. So others will specialize into one aspect, you know. So, but just take advantage of on presence to say, what can we do, Mr. Nelani, and want to engage on this particular path, you know. Then from there we'll see. Because to me, I'm only offered 2 hours with you once per week.
Yeah, no, I understand, sir. I understand what you are saying, because you know, when you skip the basic, like I didn't get the basic of that, especially on unit 2. I was hoping, because I saw that most of the calculations start there. So after we had that class that day, I was hoping maybe that's where you're gonna start, and you started here. Now I understand unit 1 and jump to unit 3, but unit 2, which got most of the basics on calculation, I'm still blurry there when it comes to that. I don't know how can I get assisted on that part.
Unless probably next week Thursday, we can push. You know, taking in my own time, we can push more than 3 hours, and try to close this. How we close this session, we try to expand more than an hour, so that we touch various aspects according to the challenges that are arising from the students. We can do that. I think next week Thursday, I can offer my extra hour. Please, so if we started at quarter to 5, I push up until 7:45.
That would be very much appreciated.
Okay. No problem. I will do that. I will do that at no cost. Actually.
Thank you a lot.
Okay. Thanks a lot, guys. Thanks a lot.
Excuse me, sir. Sorry to jump in there. I just wanted to ask, I agree with what Bongani just said. You know, the way you explain it, it brings it down to layman's terms, which makes it much easier for us to understand. So I really appreciate that. The other thing I wanted to ask, that when you, I mean, just the recommendation is that we started with 1 and now we worked with 2, and there is a bit of gap on, you know, module 2. If we can bring it in our next session from 1 to 3, like an overall picture, because then it just gives us a clear guidance on where we are right now, that would be really appreciated. But thank you so much. Today's lesson, I mean, was brilliant. Thank you so much.
I agree.
Okay. No. Thank you very much. I think would be the best approach, because what I've noticed, each and every study unit is connecting to one another and one another and one another. So if you mastered unit 1, unit 2, unit, be able to catch up. But it's fine. I will extend next week at least to more than 1 hour, so that to close up those gaps. I don't have a problem with that. I will do that. No.
Thank you so much, sir.
Thank you very much. Thank you very much. Thanks a lot. Good night.
Good night, sir. Thank you.
Thanks a lot.
Thank you, sir.
Thank you very much. Thank you very much, guys. Thank you very much, Bongani.